welcome Marc Rowan. Marc, really good to see you.
Thank you, Jason.
I love being able to do this in person. You know, you work just down the street, and actually we are all kind of coming back to it right now. What does that feel like for you? Tell me about your life right now.
So it's pretty amazing, I have to be honest. So we are not mandatory back in the office until September, but we've now hit 65% voluntary. And the experience is actually pretty interesting. People left for the pandemic, and we just so happens that in between then and now, we might have renovated the entirety of the firm. So they're coming back to a new workspace. It doesn't look like anything they've seen before, and everyone is actually having a pretty good experience.
And so what's the vibe? I mean, help me understand. Take me inside Apollo right now.
You know, the vibe is just incredibly positive momentum. I mean, you can feel it. You can see it from the things we've announced today, the new deal with Figure. Last week it was Motive. The week before it was Victory Park. There is just this palpable sense of momentum and forward progress.
And so forward progress after, I think it is fair to say, a difficult year on many fronts, obviously for the world, but this was a traumatic year for the firm, obviously.
Well, I like to say noisy. It was definitely a noisy year. But, you know, it's interesting. I did a little bit of a year in review for our largest investors. And I said, all right, let me characterize the last year the way I would. Assets under management up 146 billion. Record profits, 92 billion of deployment. We also hired 300 people remotely, from 1,300 people to 1,700 people, and turnover went down. So if I had told you that, you would have said, oh my God, really? Because the noise sometimes just exceeds the reality of what's happening. And so imagine how well we would do without noise.
Right. And yet we got to talk a little bit about the noise. The fact that you're in this job right now and sitting here talking to me as the CEO, you probably would not have anticipated a year ago. Tell me about, you know, how the firm is doing and feeling, how you're feeling in this, you know, post-Leon world. You know, Josh Harris, your other co-founder, is also exiting. Help me understand what's going on.
So maybe I'll put it in perspective of the industry, at least how I see it. The industry that we are in, the alternatives industry, everyone kind of came up the same way. You have a group of firms that started life as private equity firms. If they were really good at that, they were trusted with more capital, they got to diversify. And if they were really good at that, they got to go public. But that whole generation of firms started as private partnerships with a group of founders, of which Leon was one, and the others are very well known. We will, and we are in the process of a generational shift. So we've now done the entirety of generational shift at Apollo. And that means governance, that means one share, one vote, and that also means Leon stepping down from the firm at the beginning of the year and Josh stepping back upon the closing of the Athene deal. Now, I think every firm in our industry is going to go through this same generational shift. They likely will do it less noisily than we have, but nonetheless, we've accomplished it. So for me, this is my 36th year, 31 years at Apollo, and never had more fun.
And so what is the current effect tonally, internally, and externally of that, as you say, noisy transition and succession?
I would say it's the elimination of obstacles. So I start with, we're in a business that fortunately gets better every day. Whether we do anything positive or don't do anything positive, our business is driven by really positive forces, which makes it, we're very fortunate. So whether it is demographics, whether it is generational transfer of wealth, whether it is indexification, I know not a word, but nonetheless, of markets, or just the need for return, our business is driving forward. And while that's happening, there's some fascinating things taking place. Fintech revolution, democratization of finance, as well as just changes in the investment marketplace, which you noted in the outset. All of that is just an amazing backdrop to run and guide a firm in the alternative asset industry.
And do you feel like, and then I want to dig into some of what's happening, you know, not just with the firm, but in the broader world, do you feel like you have sort of taken the narrative back a little bit in terms of the public perception of the firm?
You know, public perception takes time, but certainly internally, the narrative has been taken back. The firm has an amazing management team. So, you know, I start by saying last year was amazing. Now, I was not fully responsible for that. I showed up at the end. I'm the beneficiary of very good trends. Jim Zelter, Scott Kleinman, they run the firm on a day-to-day basis. If you look at each of the businesses is run by a long-tenured professional. But internally, what I've done is I've chosen those places where I think I can move the needle. So I do strategy, I do culture, I do compensation, I do urgent strategic initiatives, and communication. Thus,
Right.
I'm sitting with you today. But the day-to-day running of the business is Jim and Scott.
Yeah.
And the deputies and other people who are around them who have been around for 20 plus years.
And so tell me about that process of, you mentioned the pretty significant number of people that have been brought on in the last year. You've also made some recent senior appointments. I mean, you're clearly putting your mark, it feels like, culturally and structurally on the higher ranks and even going down in the firm. Is that fair?
That's very fair. And I won't say it's certainly not me alone, but it's a recognition of where our business is going. So if you look at our business, circa 460 billion of assets under management. 330 billion of that is yield. 30 billion of that is hybrid, and 100 billion of it is opportunistic, which is, think of a traditional PE business and other PE type strategies. Each of those businesses is growing, moving, responding to different market forces. So if I start first on the yield business, the biggest trend in the yield business is the absence of spread in the public markets. Spread is the lifeblood of banks, it's of insurance companies, of other financial institutions. And if you think about the disappearance of spread, that's a pretty challenging environment. So our solution to that is to build origination. Origination allows you to control documentation, diligence, structure, and ultimately economics. And if you could earn 150 to 200 basis points more in origination at a very safe, near investment grade level, that's a business we want to build. But to build that business, you need different talent. You have to augment your talent. And we build it through something we call platforms, which I'm happy to explore with you.
Yeah, so I want to dig into that a little bit, but I don't want to get too far away from this idea that what you are building is, it feels to me from the outside, a radically different firm in some ways than certainly what people would associate with a traditional private equity firm. Fair?
I think it's very fair, but I think that the industry has not really been updated in terms of its image, because if you look at all of the firms, yes, we all are in the traditional private equity business. It will be a very important business. It's a very important source of profits, a very important source of intellectual capital, but it is not inherently a growth business. It is about maximizing returns. So if you look at what we've done, our growth engine has been yield, and our growth engine has been hybrid. Other firms have chosen other growth engines. And as I said to you in our pre-meeting, the path we've chosen in yield, I like what we're doing. We are in, as I sometimes say, the fixed income replacement business. We're 330 billion today. 5 years from now, that'll be twice its size. And the ability to get it to 600-700 billion, it sounds massive, but in the context of the markets in which they participate, it's just not all that big.
Right.
Whereas in private equity at 100 billion today, with amazing returns and a great track record, it will be bigger, but it will not be much bigger, because that business is responding to its own market forces of maximizing return versus seeking to grow it just for the sake of growing it.
All right, so when you say yield, at the core of that is a company called Athene, right? Take me back, because you are the primary architect of a strategy. This is what you've been doing, like since you've been maybe even more out of the spotlight than you traditionally were. You identified something more than a decade ago, if I have my my history right, that now is at the centerpiece of that. Take us back, and help me understand how you and the team identified that.
Well, we're always the beneficiaries of good people and good opportunities. In this case, we were identified by Jim Belardi and his partner, Chip Gillis. Jim is the current CEO of Athene, a veteran of Sun America, one of the most successful insurance companies run by Eli Broad. But if you think about the environment in 2008, great financial crisis, you had a really interesting set of circumstances. You had incredibly low rates. You had widespread, and you had the banking system under pressure. What a perfect time to start a spread lender. And I use the term spread lender rather than insurance company because if you really dig into our business, we are at our core a spread lender. We borrow from policyholders in the form of annuities, and we invest primarily in investment-grade credit, and we make money based on spread. So we started back in 2008 with what sounds like a pittance at this point, a $16 million investment. Now, fast forward 12 years, you have Athene and Athora, its European counterpart, 250 billion plus of assets under management, nearly 20 billion of capital, A+ rated, projected to earn $2+ billion this year. It's been just an amazing transition. But at its core, it is a spread business.
Right.
And if you follow my remarks, in the current environment, spread has disappeared from the public markets. So if you're an insurance company, if you're a bank, if you're anyone who needs to earn spread, if you don't have a good means of earning spread, you're suffering.
Right.
And you're generally selling your business to someone like Athene or Athora, or you're otherwise coming up with strategies to figure out how to augment the ability to get spread.
So how does that help me create the connective tissue where it becomes a part of this larger whole?
So so again, come back to, so Athene is a spread lender.
Yeah.
The growth in the business is not limited by capital. It is not limited by liabilities. It is limited by assets because it only makes sense to grow if you can earn spread. If you can't earn spread, there's no point in growing.
Yeah.
And so the affiliation between Athene and Apollo was fundamentally founded based on the ability to earn spread. And spread, not just in a traditional sense, but if you think about what a retirement services business wants, it does not want to take credit risk. It does not want to take equity risk. It wants to take liquidity risk or get paid for holding less liquid but highly rated assets. And so what we have built since 2008 is we've built a $330 billion business to serve two clients, Athene and Athora, to deliver them this kind of originated, differentiated spread.
Mm-hmm.
Now, initially, it was just Athene and Athora. Apollo was building fast to keep up with how fast Athene and Athora were growing. At this point, we now have nearly 80 to 100 billion of client money side by side with Athene and Athora because other financial institutions also need yield. Other clients need yield. Pension funds need yield. Our credit products need yield. But the business we're in is a fundamentally different business than any of our peers.
Right.
We are in the fixed income replacement business. I like to say it's the pile of assets in the world that yields less than 5% is like this big. The pile of assets that's in opportunistic credit, higher yielding, a little more risky, it's this big.
Yeah.
I want to play in the big pile. And we've built a business that is an origination-focused business that competes in many ways with what I would formerly have said traditional banking institutions or the GE Capitals of the world. But it is not a risk business. It is an origination business.
Right. So what you just said, again, is radical in some ways if you are coming at this from the perspective of, I think about Apollo in the same breath as Blackstone, KKR, Carlyle, and TPG, right? If you sort of Bain, sort of the traditional private equity names, you're starting to sound more like Berkshire. You're starting to sound more Berkshire Hathaway. You're starting to sound more like some other firms out there. Help me understand, sort of compare and contrast, what that universe looks like with Apollo in it.
So I'll start backwards. I'll give you what I think is the connective tissue of what we've built. We have defined our business as a business of excess return. And we offer excess return from AA down to private equity. And it's up to clients to figure out where along that spectrum they want to seek out the Apollo platform. So we are not in every asset class. We are not in every product. And the delineation for me is, can we earn excess return on a sustainable basis? Otherwise, the product is commoditized, and we really are not in the AUM growth for AUM growth's sake business.
Right.
So if you think about what's happening to our clients are, on the institutional side, more and more sophisticated. Initially, they came to us and to our peer group for one product, private equity alternatives. Okay, that's 10% or less of a traditional institutional portfolio. The other 90 was served primarily by fixed income and public equities. Well, if 40% or 30% of your portfolio is in fixed income and there's no return, boy, you better get creative if you're going to provide for your retirees. So increasingly, clients have sought us out and our peer group out to fill in other parts of their product set.
Right.
And it is that we do for our clients. The largest clients are typically not one product investors or two product investors. They may be 10 product investors. They may be managed account investors, or they can be like Athene, where we manage the entirety of the balance sheet, which is what we've done for Athene for the last 10 years, from AA down to alternatives.
Right. So is it fair to say then that as Steve Schwartzman and John Gray have expanded into real estate, hedge funds, the credit business through GSO, as other of your peers have gone into growth equity and venture type returns, this is the path you have chosen to create those different avenues or those different products, as it were, for your customers?
So the answer is yes. Each of us is doing something different. But as I shorthand our business plan, I tell our clients that when you look at us today and then you look at us in 5 years, we will be twice as large in yield. We will double the size of our yield business, and our hybrid business and our opportunistic business, I believe, will be 50% larger, coupled with a thriving capital markets business, which connects all three of those businesses. Blackstone has gone on another path. Blackstone is also in the spread business.
Right.
And this is kind of an interesting thing. They derive spread through the management of public and private REITs, and they receive fees for doing that. We derive spread through the management of an insurance company balance sheet. We can debate which is better and which is worse. At the moment, they're afforded a higher valuation on the spread associated with those assets versus the assets that we are. But I like where we are.
Yeah. And what this ultimately does, again, just sort of like distilling it down, it gives you a massive balance sheet, right? I mean, in some ways.
Strategic capital. It's funny. We, with the purchase, the merger, the full consolidation of Athene, we've heard a lot of balance sheet light versus balance sheet heavy.
Yeah.
I think people have missed the point. The point is not whether you're dragging capital or not dragging capital. We acquired strategic capital when we bought Athene. But we did it by buying something that was producing massive amounts of earnings, that has $5 billion plus of excess capital, and where at any point in time, we, to benefit them and to benefit the rest of the Apollo ecosystem, can rely on their balance sheet. I think the deployment of strategic capital is going to be one of the differentiators in our business.
Right.
Now, others have gotten by thus far with a full balance sheet light strategy, and more power to them. KKR has not. They've gone in a similar direction to the direction we're in. But I think you will see us, as the merger closes, increasingly use strategic capital to just make things go better and faster and stronger. We already rely on Athene and Athora to launch new products, launch new teams, launch new funds. And I think we're just going to do more of it.
And do you feel like Wall Street, as a publicly traded company, of course, you're serving a number of constituencies from an investment perspective. Do you feel like Wall Street writ large is starting to understand the story? How hard is it to sort of convince them that this is something new and different from a valuation perspective of the firm?
So I think we're in early innings. I'd say this is one of our challenges, but it's a challenge I relish, because ultimately logic will prevail here and execution will prevail. So we have built something that the Wall Street analyst community has not seen before. It is not Berkshire, it is not Brookfield, it is not BlackRock. It is Apollo, and we're building something that's unique. We are a firm that generates FRE from our asset management business, and I like to say SRE, spread-related earnings, from our retirement services business, and it's a massive pool of earnings. And what we've told the street is we will grow our business 15% plus cash on cash year over year, and I think that's really good. Plus, we get, as I like to say, some embedded options. One embedded option is this democratization of finance. The other is the overlay of everything that's happening in fintech, and you're starting to see little pieces of the strategy come to the fore with the investment in Motive and the relationship with Figure.
So democratization of finance, puts me in the mindset of trying to understand your ultimate investor base. There's long been this holy grail of retail investors and 401ks and, being a pool to tap. Where are we in that journey from both a product perspective and a regulatory perspective?
Really early innings. And so I think you're seeing a migration. Look, the institutional business is the bread and butter of alternative asset management, broadly defined. But what you've seen in the past decade is this unbelievable creation of wealth, whether it's been entrepreneurs coming out of technology, or it's been entrepreneurs coming out of the public market, or it's just been the generational transfer of wealth. So before you get to 401k and true retail, you're watching high net worth become really high net worth. And the product development, the product sophistication is now moving to a par with institutional. A lot of the most interesting product development is actually taking place in that channel, the so-called QP channel. I think that's where you're going to see the democratization first take place. And I think you will see it move to mass affluent. Whether it eventually gets to retail or not will be a function of the regulatory environment, politics, and a variety of other circumstances. But institution is going to grow. Institutional business is going to grow. But this high net worth channel and the QP channel and the mass affluent channel is just too big to ignore. And it is maturing in its sophistication. And I think you're starting to see Apollo and peer firms really reach out and serve it. I mean, people forget, in buying Athene, we bought a 25 to 30 billion a year organic business. Now, it's not organic the way that you've described it, but the tools to serve clients on a mass affluent basis are there.
Yeah. And so I want to talk to you in a minute about sort of the state of the world. But before we do that, I have to ask you.
I was hoping you would tell me about the state of the world rather than ask me.
Yeah. Well, I was in Las Vegas last week. We could talk about what the world looks like from Las Vegas, but that's not a very good, maybe not a great proxy. Although maybe it is. You have some experience there. Tell me about private equity, though, as it sort of moves forward in the context of Apollo, because it is what you made your bones on in many ways, and a lot of your competitors. Where does that fit in?
So, hugely important business. It will continue to be a hugely important business. It is a massive source of profits for ourselves and our clients. It is, as important, a massive source of intellectual capital for every part of the firm. It is just not the same growth trajectory as some of the other businesses, but nor should it be.
Yeah.
Now, we, at the end of the day, we've made a decision. We serve clients, and our job is to serve clients and provide them excess return. Accepting more capital in excess of the opportunity available just means returns go down. So private equity is a little bit like the farming business. You plant, you harvest. You plant, you harvest. The business goes up. You sell things, it goes down. That is just the nature of the business. Excuse me. And for as much as people have said, and I've seen a lot of the press, too much money chasing too few deals, I think I joked with you previously that I've been hearing this for 36 years.
Right.
When I arrived on Wall Street in 1985, I said, oh my God, I'm 10 years too late. Every good deal's been done. And in 1990, when we started Apollo, I was a junior person. I was like, wow, I'm just too late for me. And 2001 was actually the funniest. 2001 followed the collapse of Internet 1.0, the telecom bust, the events of 9/11, and a lot of GP mistakes across the board. Some firms actually disappeared as a result of their performance. And GPs were telling LPs that the new private equity model is 15%. And I was on a panel with, I think, the head of New York State.
15% returns.
That was it. That was what GPs were telling LPs. And Apollo was seated next to the host. And then, Bain, Blackstone, Carlyle, down the row. It's kind of the murderer's row of investors. And so I was asked the question first, what do you think returns are going to be going forward? And I said, I think they're going to be amazing. I think they're going to be 20% plus. And all I heard was, and that was the sound of everyone's head hitting the table going down the row. And in that fund, which was the 2001 fund, 44% net returns. So now you fast forward and you look at the last 3 funds we've done, big funds, 15 billion, 16 billion, the most recent fund, 26 billion, 25 billion, excuse me. For the last time we announced results, 44% gross on the $25 billion fund, high 20s net. The world just keeps moving. The world just keeps changing.
Right.
It's our job to continue to reinvent ways to extract and to produce value. Now, for us, the way I define our strategy is purchase price matters. Some people call that a value investing strategy. But value investing does not mean you only buy value-oriented companies. You want growth. Of course, everyone wants growth. You want to buy technology. You want to buy into change. But purchase price matters. And so you do the Tech Datas of the world. You do the Yahoos of the world. You do a series of transactions where you think as a result of complexity, as a result of something being misunderstood, you can derive excess return. So I am very positive on the business. I think it will continue for a very long time. I think we will continue to see articles of too much money chasing too few deals, and it will continue in a 35-year unbroken trend of people being wrong about that.
And so, we started out by talking about, this past year and the performance at your shop, but also broadly. I think a lot of people looked at their 401ks, in the last couple months and looked over past 12 months performance and went, oh, okay, well, that didn't look so bad. How does that translate through to valuations as you're assessing deals at this point?
Look, it's a really interesting question, and it's also a management question, because ultimately you're trying to judge the success and the caliber of the people who work with you. And right now, good market performance, a secular trend of rates going from high to low, valuations going nowhere but up, it's masked a lot of mistakes.
Yeah.
Which is fine. That's part of the game. That's part of the investing cycle, is understanding that mentality. But I do think that we're entering a more difficult period. Right now, we're on the spending binge following us all being in lockdown, government spending around the world, with all of the other issues that are coming along with it. But we at our core are a slower growth, slower population growth, slower GDP growth, higher government spending economy. And I do think we will be back at a point where purchase price matters. Purchase price, I believe, always matters.
Yeah. Let's talk about some of the industries that you're investing in. Parochially, I'm fascinated by what you're doing in media. Tell me about that strategy, because I'm not sure, certainly looking over the past 4 to 5 years, people are like, I want to be in media, man. But yet you guys and some of your competitors have seen fit to invest in some, relatively robust ways in media. Help me understand that.
So we have a long history in the media business. I said jokingly sometimes, we historically have invested in media's past and media's future, because media's present is always too expensive, because the established companies are willing to pay multiples for things that probably exceed our pricing expectation. So if you've looked at the last couple of things we've done, they've been in the TV station business, Cox and otherwise, and also in Yahoo. Yahoo, at the end of the day, is still one of the most visited websites anywhere. And one now needs to go in and unpack a series of opportunities on a very granular basis and maximize that series of opportunities, whether it's financial reporting, as in Yahoo Finance, or it's in gaming, or it's just in access. But I continue to believe that media, because it is evolving so quickly and the models are changing so fast, will be a source of interesting opportunities. Change is actually a really good driver for our business. It leads to divided camps on valuation, divided camps on futures, and futures of business. And if you come with a point of view and a well-researched thesis, you often can build significant value.
And when you think about sort of that opportunistic set, and you look through the various lenses you have at your disposal, is it, and I know that this is case by case, but generalize, if you will, a world that is more friendly for you to equity investments, to credit investments? How do you assess the opportunities out there?
Look, I think I step back and I look at the three businesses. So, and of the three businesses, yield, hybrid, and opportunistic, only one business as a whole is short capital, and that's the hybrid business. And what's interesting is this goes to another kind of trend in our business. So on the yield side, there's an immense amount of money chasing yield. Everyone is looking for yield. and therefore proprietary origination, controlling your own capacity to generate yield,
Right.
is what you need to do. And we're doing it. We wake up every day. That is one of our key planks. On the opportunity.
And sorry to interrupt you, but that's essentially like nice, safe, AA, relatively low return, right?
I won't say AA. I think what we've done is we've actually built, in a good way, without the cautionary tale, a mini GE Capital. You look at businesses like PK Aviation, aviation finance, Donlin, fleet finance, midcap, corporate finance, Redding Ridge, structured product finance, net lease. All of them provide premiums over investment grade.
Right.
Triple B, single A, et cetera.
Got it.
That's a business, and that's a huge business, but it's also a really competitive business. Flip to the other side of the spectrum. The opportunistic business is about opportunity.
Right.
And sometimes there's a lot of opportunity, and sometimes there's not so much opportunity. You can't force that business. Some years, like this year, when prices are high and there's a lot of activity, we still have found a lot to do. Other years in the same environment, we'll find less to do. Returns have to be high. But structurally, there's a lot of money in opportunistic, and structurally, there's a lot of money in yield. This thing called hybrid, which is 30 billion, is actually really interesting because it is neither yield nor opportunistic. It is never going to be the highest rate of return. So if you think about the way institutions, sovereign wealth funds, pension plans invest, they typically use alternatives on a strategic asset allocation to get return. So they typically allocate most of their capital to the highest returning alternative, not the best risk reward. As a result, this thing in the middle, hybrid, call it mid-teens, lower rate of return, lower risk equity, actually finds itself short capital. That's a $30 billion business. I think that business will be 2.5 to 3 times its size in the next 5 years. It is probably the best risk reward today, and it is certainly the most active part of our business.
And so what's a typical deal? Like, give me an example.
So in the financial crisis, it was providing capital to companies that for one reason or another did not have capital. So think of Expedia, think of Albertsons, think of a few other companies like that. Think of it as partner capital. Think of it as strategic capital. Think of it as continuation fund capital. A GP wants to move something, their best company, from fund A to fund B and needs an independent validation.
Right.
We're an independent validation. It is almost always minority stakes. It is almost always structured, meaning it has some form of downside protection. And in an environment of very low rates and very high multiples, it is simply the best risk reward.
Yeah. As you've described all this, to sort of, widen the aperture a little bit, and I'm taken by what you said about, coming to Wall Street in the mid '80s and sort of seeing all these things evolve. It feels like we're at yet another inflection point when it comes to Wall Street and the characters and the nature of the firms, maybe that we haven't seen since the financial crisis in many ways, in terms of who's doing what. How would you describe the current landscape of Wall Street?
So I'll talk about our business. And, people can extrapolate and go from there. I've told our internal team our business is going to change more in the next 5 years than it's changed in the past. And it's changed a lot in the past 5 years. And what we're seeing is this collision, if you will, of commoditization of financial markets. Think of the whole movement in ETFs, open-ended mutual funds, derivatives trades, and a variety of other things that make public markets really, really efficient in the absence of spread in the fixed income markets and the absence of available returns in the equity markets. Huge implications for how the business works. The second is you're seeing the maturation of the alternatives business. You're seeing firms like Apollo standing up for and underwriting investment grade deals, whether it's ADNOC, AA, Hertz, or others. We're now standing up and taking down $4, $5, $6 billion transactions and holding a piece for ourselves and then syndicating to other like-minded investors, a traditional Wall Street function. But you're also seeing us partner with the Wall Street firms. We're now of a size and scale. So there are no permanent friends. There are no enemies. Everyone is a partner. People are very aware of their behavior and market conduct, given the environment we live in. But you have on top of this amazing mix. You have technology and technological change, and you have fintech, and you have this democratization of finance. I mean, if it doesn't, the thing that strikes me, think about it, millions of Americans sent their money to a place called Robinhood to trade complex options and other products. I don't mean to say anything negative, and I'm not positive nor negative, but it just struck me that if that's not a sign that the markets are moving and the markets are changing, all manner of fintech companies are gearing up to provide the kind of services that have historically been provided by traditional investment firms on the one hand and banks on the other hand. Some of those firms will have balance sheets. Some of those firms will not have balance sheets, and they will partner with people like Apollo, who will be their balance sheet.
Right.
So how this whole realignment takes place, I can't tell you. I believe it will result, as I've said, when I say democratization of finance, I don't just mean on the retail side, the high net worth side. I also mean on the origination side. You know, the financial crisis in 2008 pushed a lot of activities out of the banking sector and into the non-bank lending sector. Some of it for good, some of it for bad. It's a wide-ranging debate, but it's happened. And those activities, I believe, are going to continue to take place outside the banking sector as credit formation increasingly is done with investors who have matched capital to provide this. So we're in a really interesting period of time. It makes it incredibly exciting to come to the office each day. It also means the culture needs to accept this.
Yeah.
And part of my job is to prepare the culture to accept it, to make sure the speed of decision making accepts this.
And you know, you mentioned Robinhood, which I think as we look back, at least through a financial markets and financial services lens, will be one of the legacies of this tumultuous period. The other one likely will be, for those of us who lived through it, the SPAC. You know, I mean, something that just sort of burst onto the scene, now seems to be receding a little bit. How did you sort of assess that in the moment, and what does it tell us in the broader scheme about kind of the function of capital markets?
Look, I think we're watching financial innovation. Absent significant regulatory change, I think you will continue to see a thriving SPAC market that will go through cycles of capital being plentiful and capital not being so plentiful, which is kind of where we are right now. But we're in a history of financial innovation. I mean, if you look at this from the start of my career to today, and you look at the products offered by a traditional mutual fund, you know, it was pretty vanilla. You know, go look at the offerings today. It's like this. There's an encyclopedia now. SPAC is another form of financial innovation. It was a way for a growth-oriented set of companies to access capital markets in a much faster, much cleaner way than a traditional IPO process. You have that along with direct listings, which a number of technology companies have undertaken. I think the SPAC ecosystem is here to stay. Maybe not at the same size and scale. We have been beneficiaries of the SPAC ecosystem. We view it simply as an extension of growth investing.
Beneficiaries as a seller?
Beneficiaries as a seller,
yeah.
Beneficiaries as a capital provider, beneficiaries as a sponsor. Every possible way you could participate in the SPAC ecosystem, we have been big participants in the SPAC ecosystem, and unabashedly, unashamedly.
Yeah.
This is financial innovation. Those firms that had big growth equity investment capabilities, you know, kind of said, well, everyone else who is participating in this, they just can't raise growth capital. I think they've missed the boat. I think there's this incredible market out there that is very inefficient because of the way the process works, where firms like Apollo at our size, scale, and capability for analyzing deals and providing capital, I think we can make a lot of money for our clients.
And so as you think about, as we start to wrap up a little bit, and you think about kind of what's on the horizon, you know, a lot of political headlines, a lot of market headlines, you know, we continue to sort of wrestle with the aftermath, hopefully, of a pandemic. Infrastructure is something we're all very focused on. Is that a play for you? That was one of the questions that came up a lot as I was talking to folks about investment opportunities out there.
Look, the answer is massive opportunity. We already are huge participants in the infrastructure business. A lot of it has been on the debt side, on the project finance side, and increasingly on the equity side. But I come back to the Apollo overlay. Can we earn excess return relative to the risk in this asset class? So infrastructure has been a crowded trade for a long period of time. And at the most secure end of infrastructure, it is possible, and I believe, that returns have been arbitraged away. Capital formation has done that. But in every market, there are inefficiencies, and our job is to build an Apollo-esque infrastructure business on the equity side and scale it, if it can be scaled. And I believe it can be scaled. In the meantime, we're a massive credit provider to infrastructure, to energy transition, to pipelines, to solar fields, to electrification of gasoline stations. I mean, what traditionally we thought of as infrastructure is also changing. And we just have to keep evolving our definition and looking at cash flows and looking at transactions in the context of the markets that exist. But you know, your point is a broader point. There's massive change. I look at our workforce. We are a majority millennials workforce. How we approach infrastructure, hugely important. How we approach back to office, hugely important. How we approach social and other issues, hugely important. There's a whole education that our generation is getting as to the evolution of markets and the evolution of cultural and social markets.
So I do wonder, you know, as someone who was sort of, you know, away from the day-to-day management of the firm for some time and now being in like the seat, what have you learned over the past few months about the firm, about the world, about yourself? Like, what do you kind of take away here?
Look, I hope I've been doing this for 35 years. I like to think I'm somewhat self-aware. I am good at some things, and I am not good at other things. So I've been handed a firm that's in incredible shape. I've given you the metrics, given you the financial results. I have an amazing team who lead the business day to day. Where I think I can add value is strategy and looking around corners at how markets are going to evolve. And whether that was the creation of Athene, the launch of AAA, the launch of the first BDC, I like to work with a white sheet of paper. I'm very good at working with a white sheet of paper. Culture, I've said it, we're a millennials workforce. There's a different set of expectations as to what the work environment physically, emotionally, and from a futures point of view is going to be. I believe I'm a very good manager of change, and that little piece of sand in the oyster in really catalyzing change and forcing people to evaluate uncomfortable truths about the business. Communication, you can have your own judge as to whether I'm a good communicator. You are my first TV interview, so you know, maybe you'll have me back, maybe you won't. But I like to think that when I speak on topics that I am knowledgeable about, I'm successful in conveying the essence.
Right.
And boiling it down to its most simple notion. I like to make complex things simple. So that's what I think I'm good at from a leadership point of view. Notice I didn't say I'm running the business day to day.
Right.
I am fortunate that I don't run the business day to day. In fact, Apollo is fortunate that I don't run the business day to day. Jim Zelter and Scott Kleinman make the trains run on time. And Jim Belardi, Bill Wheeler, and the team at Athene make the trains run on time. It would not be my, you know, highest and best use. So positioning myself to lead, to be a strategist, to be a culture carrier, to help us move through this period of generational change and technological change and market change and social and political change. Boy, this is like the best stuff out there.
Yeah.
Where else do you get this combination of interesting ingredients on a massive scale?
And when you think back to 1990 and sort of hanging out the Apollo shingle post Drexel and sort of looking at all of this, and you think about where we are in 2021, how different in scope, scale, and perspective is this from what you expected?
It's night and day. I could never have imagined where we are. Not even possible.
Right.
But you know, look, the business has changed massively. It will continue to change massively. Change is a constant. But it starts with one thing. Ultimately, the best team, the best culture, win. So focusing on culture, hugely important to what I'm doing. I'm very focused on it. Team, the articulation I've given internally is we are striving to be the best place to be a partner in the financial services industry, bar none. That's a high bar.
Yeah.
But we've seen in other firms where you lose sight of that. At the end of the day, we offer our clients one product, judgment. That's it. We only offer judgment. And judgment comes, in my opinion, over a very long period of time, seeing what we do and what we don't do, because we want you to bring Apollo judgment, informed by everything that we do and know. So once you're with us, we want you to stay for your entire career. That means it has to be satisfying financially. You have to like the people you work with. You have to like the environment. You have to like how decisions are made. And the absence of stupidity. That's it. Focus on the people. Avoid doing stupid stuff.